Silver just made a kind of move you almost never see when markets are relaxed. While most people were asleep, it didn't crawl upward. It didn't poke at resistance. It rocketed straight up, fast, aggressive, and violent. The type of price action that makes short sellers break into a cold sweat and makes longs stare at their screens thinking, hold on, is this actually happening? And here's the part that should really get under your skin. This doesn't look like a standard panic move. It looks coordinated without being coordinated. It looks like two opposing sides both stepped back at precisely the same moment and, without intending to, struck the same match. Before we dive in, a quick note. If you get real value from these kinds of breakdowns, please subscribe. It helps more than you might realize. It's Tuesday, January 27th, and right now it's 5:15 a.m. here in New York. Drop a comment with what time you're watching. I'm always curious how global this audience truly is, and once you're done, check the description. There are extra links down there, including access to a premium WhatsApp channel and a channel membership option. All right, let's unpack what just happened, why it matters, and why I believe the most important question right now isn't who's winning, it's who can survive what comes next. Because I'll be straight with you. If you think this is just a chart story, you're already behind. Overnight, silver opened around the low 100s and then simply refused to stop. It kept pushing higher until it was trading around the 1 to 10 area. At the same time, when Asian markets came back online, Shanghai didn't just follow the move, it overshot it. Prices there surged sharply, printing levels well above US futures before eventually cooling off. And it's that gap between the two markets where things start to feel different. Here's the simplified version. When Shanghai is paying a significant premium over US prices, it usually signals that physical demand and urgency are concentrated there. When that premium narrows, one of two things typically happens. Either buying pressure is fading, or US prices are being pulled upward to catch up. Last night, the sequence was unmistakable. Asia struck the spark. The premium widened. Then the premium began to compress. But demand didn't vanish. Instead, US prices rose into that spread. And that matters because this wasn't one market sneezing and the other catching a cold. This was one market grabbing the other by the collar and dragging it higher. Now, you already know what comes next. People go hunting for a villain. They want a single culprit, a single lever, a story simple enough to tweet. So you're hearing two dominant narratives. One camp says, a major US bank is in trouble, they're trapped, they're blowing out. The other camp argues, no, it's China that's under pressure, they're desperate. They can't source metal and price is punishing them. Those two stories can't both be cleanly true in the way they're being sold. In a deliberate squeeze, one side usually benefits while the other gets crushed. That's how the internet prefers it. Heroes and villains, winners and losers. But markets don't always deliver a tidy movie script, so here's my take. And if you stick with me, I'm going to connect silver, copper, oil, and rare earths into one deeply uncomfortable picture that almost nobody wants to discuss. I think what we're witnessing is defensive behavior, massively defensive behavior from multiple players at the same time. Not an intentional squeeze, not a chest-thumping my supply is bigger than yours contest. It's a sudden realization that in a world where supply chains can be sanctioned, rerouted, weaponized, or simply snap, you don't wait for inventory. You secure it, you hoard it, you lock it up, and you do it even if the price hurts, because the alternative hurts more. That's the difference between a speculator and a real end user. A speculator cares about price. A real user cares about availability. And right now, availability is the battlefield. Let's start with who feels the pain first, because that's often the clearest signal of what's actually happening. At the corporate level, silver at these prices is a brutal headline for a lot of industries. Solar manufacturing is a big one. Silver is critical for photovoltaic cells. Even when manufacturers reduce the amount of silver per panel, scale eventually eats those savings. When silver jumps, costs jump. And when costs rise, margins get squeezed, unless demand is so strong that those costs can be passed on. So if you're running a solar factory and you see silver moving like this, you don't sit back and say, we'll buy it on the next dip. You pick up the phone, you pull purchases forward, you lock in whatever supply you can get your hands on. The same applies to electronics, certain medical uses, and a long list of quiet industrial applications that don't get headlines because they're not flashy. Here's a critical point that's been building for years. Industrial demand for silver doesn't need to be the majority of total demand to drive the market. It just needs to be inelastic in the short term. If a factory needs silver to meet contracts, they'll pay whatever they have to. That buying doesn't wait for confirmation. Based on recently published industry data, industrial silver use runs in the hundreds of millions of ounces per year. Even minor disruptions in supply can create ugly bottlenecks. That's why sharp price spikes often start with users, not investors. 2 weeks ago, someone made a point that's becoming impossible to ignore. For years, the assumption was that investment demand would front-run industrial demand, that the public would rush in first and industry would react later. But what if that's flipped? What if industry is now front-running the public because it has no choice? If that's true, then the classic sell the spike strategy becomes dangerous. Because the bid underneath the market isn't just hot money anymore. It's procurement departments, and procurement departments don't care about Fibonacci retracements. So where do the banks fit into this? This is where things get messy. In the US, much of the silver ecosystem runs through financial plumbing. Futures, options, clearinghouses, bullion operations. When a market snaps higher like this, anyone with large short exposure, whether hedged, structural, or assumed safe, can feel stress. Does that mean one specific bank is about to implode? I'm not going to sell you that kind of certainty. People love pointing at a logo and declaring, it's them. But real market stress is rarely that cinematic. What I will say is this. If you're a large financial institution that depends on orderly markets and silver starts behaving like a meme stock with industrial backing, you're not celebrating. Even if you can trade volatility, disruption is expensive. You might hedge, you might reshuffle exposure. But when the plumbing starts to clog, the entire system pays a tax. And here's what most people miss. Pain can exist on both sides at the same time. China can be hurting because its industrial base is absorbing higher input costs. US banks can be hurting because positioning and market-making functions are under strain. Neither side has to be winning. Both can be trying to minimize damage. That's why I call this defensive. Now zoom out, because this is where it stops being a silver chart and starts looking like geopolitics wearing a disguise. Think about the broader resource chessboard. Rare earths, critical minerals, copper, oil, silver. These aren't just commodities. They're leverage. Over the last few years, we've watched nations treat supply chains like strategic assets. We've seen export controls, sanctions, politicized shipping lanes, and governments building stockpiles, not because they enjoy tying up capital, but because they're terrified of being cut off. Here's the uncomfortable possibility. Silver is being pulled into that world. Not because silver is the only thing that matters, but because it sits at the intersection of money, industry, and security. Control the flow of critical materials, and you influence the behavior of whoever needs them. Latin America is a major piece of this puzzle. Silver production is concentrated in specific regions. Mining, refining, shipping, financing, these are choke points. And when global powers start exerting influence in the same neighborhoods, supply chains harden. In plain language, everyone tries to lock up what they can. If one side believes access will tighten, they buy early. If the other side believes the same thing, they also buy early. That's how you get a price explosion without a mastermind. Everyone hoards, everyone retreats, everyone assumes it's temporary, and then the price says otherwise. Now let me slow down and explain why the Shanghai premium and how it moved matters so much, because this is where many people get misled. When two major markets trade the same metal at different prices, arbitrage usually closes the gap. Traders buy the cheaper market, sell the richer one, and pocket the spread. That's how efficient markets are supposed to work. But arbitrage only functions when metal can actually move. If export rules, shipping delays, financing costs, and delivery constraints make physical transfer difficult, the spread doesn't close the textbook way. It closes the hard way, by pulling the cheaper market up. Why? Because the buyer with urgency is willing to pay almost anything to avoid being the one explaining a production shutdown. That's why a stubborn premium is a warning light. It suggests the constraint isn't just paper, it's logistics and availability. It's the difference between owning price exposure and owning bars that can be delivered on time. And here's the deeper cliffhanger. If the problem is logistics, you don't fix that with a dip. You fix it with time. And time is exactly what panicked buyers don't have. So when someone confidently says, don't worry, the spread will close, ask the next question. Close how? Through metal flow or through price repricing? Those are radically different outcomes. Another thing that doesn't get enough attention, silver isn't like oil. You can't just ramp production overnight. A large portion of silver supply comes as a byproduct of mining other metals. Even if silver prices explode, you can't flip a switch and create new supply next month. Mines are planned years in advance, grades decline, permits take time, energy costs matter, recycling helps, but it has limits. Silver is scattered in tiny amounts across millions of products. That makes the market more fragile than it looks when demand surges. If industrial buyers decide not to gamble, and investors decide they want insurance, the same ounce gets chased by two different motivations. That's how price overshoots happen. Now let me challenge a popular oversimplification. Many people frame this as a clean US versus China tug of war, where one side outspends the other until someone taps out. Reality isn't that neat. Yes, the US has enormous financial flexibility, but commodity inflation is a boomerang. Squeeze inputs hard enough, and you raise costs inside your own system, especially when manufacturing, defense, and infrastructure still depend on the same materials. The smarter question isn't who can outspend whom, it's who can absorb the second-order consequences without breaking something critical. Because when silver surges, copper tightens, energy stays volatile, and rates do their own thing, stress doesn't stay contained. It spreads. That's why I keep returning to this question. Who benefits and who suffers? At the corporate level in Asia, high silver is a gut punch for manufacturers operating on razor-thin margins. At the corporate level in the US, stress shows up in the financial layer. Desks, risk managers, clearing systems. At the nation-state level, Asia generally dislikes imported commodity inflation that erodes manufacturing competitiveness. The US, by contrast, can tolerate more volatility because its economy and currency system cushion shocks differently. That mismatch matters. Now add another layer. Governments are getting louder about critical minerals. Policy language is shifting from free trade to strategic reserves. When that tone changes, private players don't wait for legislation. They act immediately. They buy, they stockpile, they sign long-term contracts, and the spot market becomes collateral damage. So when silver gaps and surges like this, you have to ask, is this speculative fever or is it a scramble for physical availability? If it's the latter, the next phase isn't a polite pullback. It's rationing by price. A lot of viewers ask, what's the tell? What do we watch next? Here are the signals. Watch regional spreads. Persistent premiums mean urgency remains. Watch how price behaves after the initial shock. Real shortages don't unwind in a single session. Watch boring industrial headlines, procurement, inventories, production tweaks, and watch related materials. Silver doesn't exist in isolation. To really read this market, you must separate paper demand from physical stress. At first they look similar, then they diverge violently. Paper demand moves fast and can reverse fast. Physical stress asks uncomfortable questions. Where are the bars? How long does delivery take? Who actually owns what? Inventory classifications matter. Not all reported inventory is deliverable. Open interest behavior matters. So do lease rates and backwardation. None of these are perfect alone. But when they line up, that's when markets change character. Silver is notorious for trading deep until it suddenly isn't, not because metal vanished, but because free supply was never as large as paper markets suggested. So if you're waiting for tomorrow's headline to explain today's move, you may already be late. Now let me pause and make this practical. If you've been successful, share your story in the comments. It helps others stay motivated. And tell me, do you think this silver move is driven more by industrial panic buying or financial positioning unwinding? Let's run through the morning snapshot. 10-year yields are modestly lower. The dollar is softer. Equities are mixed but leaning positive. Volatility is higher. Gold is surging through a major psychological level and holding. Silver is the headline near 110. Shanghai silver remains at a premium. Copper is up. Oil is slightly lower. Natural gas is higher. Crypto is up. Other precious metals are higher. Grains are mixed. Here's the question. If this were pure risk on, why is gold acting like the world is on fire? Exactly. Now the bigger context. There's a macro framework circulating that compares today to the mid-1970s. Heavy fiscal spending, intervention risk, inflation returning in waves. Back then, inflation didn't move in a straight line. It surged, retreated, then came back. Gold acted as a stress gauge. Commodities followed because the world kept building. If inflation returns in bursts, markets can look calm on the surface while purchasing power erodes underneath. That's prime territory for metals to move before the public understands why. Silver flips from ignored to unavoidable very quickly because it straddles growth and protection. That leads to another reality. Big institutions rarely lead trades publicly. They join after confirmation. When gold becomes the hedge of choice everywhere, it either means crowding or a regime shift. Silver is acting like it already knows which one it is. Add rising talk of gold custody and repatriation. That's not retail noise. It's trust erosion. Add policy momentum toward critical mineral stockpiles. When governments stockpile, private players already have. So is this the top? I'm not pretending I can call the exact tick. What matters is structure. Holding gains, consolidating, then pushing higher suggests repricing, not a blow-off. Above-ground inventories aren't infinite. Free float can be far thinner than assumed. That's why moves like this happen. Now connect silver to copper, oil, and rare earths. In a world of strategic competition, supply chains become pressure points. There may be no mastermind, just hoarding, policy shifts, and fear of being last. When spreads widen and gaps appear, it shows disorder. Asia currently looks like the buyer at the margin. If that buyer keeps paying up, what happens when retail finally notices? That's the moment to watch. Do you think the next shock comes from supply disruption or paper market stress? Drop your thoughts below. To close this out in plain English, silver didn't explode because one side trapped another. It exploded because everyone is afraid of being last to secure supply. This is a global retreat into resources. If that continues, silver becomes a bargaining chip alongside copper, oil, and critical minerals. Nothing here is guaranteed, but it's worth thinking about, because the right question isn't comfort, it's consequence. If you want more of these morning-style rundowns, like the video, subscribe, and tell me what you want next: metals, energy, currencies, or geopolitics. I'm rooting for you to win, with discipline, patience, and clarity. I'm John A.G. Stay sharp. The quiet part is usually the loudest. And finally, everything here is for education and discussion. I'm not your financial advisor. I don't know your situation. Use this to think better.